Welcome to Subramani. I'm going to talk to you today. This is more addressed to the financial advisors rather than the DIY investors. But DIY investors can also watch this anyway. So, what I'm going to talk about is what the client says, what the client means, and what you understand. There could be a gap. So look at some of the things which when you talk to clients, look at what they say and what they mean. So for example, today in a bull market, we are in a bull market, there's no doubt about that. We may see intermittent corrections, but thanks to a robust SIP market or whatever it be, the markets are definitely doing well, even though FIIs have been selling, maybe there is DI buying or whatever, people are buying, no doubt about that. So the first thing that when I look at a portfolio and somebody comes and asks me for a portfolio review, I tell them that, well, you are very excessively equity oriented. Somebody like with say 70% in equity and 30% in debt. This is more to find out what they really want. Actually, I am 90% in equity, so to me it doesn't matter. And they say, no, I have a very heavy risk appetite and I can do that. So I don't then say, well, markets could fall. I think that's something which they also know. Then I ask them something different and I say that what if your daughter can't go to the college that you are intending to, because you've got only 5 years to go. She's already 12 years of age, 13 years of age. So if she wants to go to a college at undergraduate level, and if you can't afford the college which you want to send her, which you have in your mind that it's going to cost you 1.25 crores and you will not have that money in the fund in which she is invested, and then so that is more scary, because the market could behave very badly over the next 5 years. We have had a longish bull run, so market could have a longish bear run also. We need to be prepared for that. So when you have hard goals, so I remind them about their goals. I tell them, look, this is the goal which is important, which your daughter must achieve. So it's a great time to be something like 80% in equity and 80% in debt and 20% in equity, simply because 5 years is too short a period to be so heavily in equity. So instead of trying to cajole a person to go from 70% in equity to 60% in equity, it is easier to remind them about the goals that they have to achieve, right? So buying a car can be postponed by a year or two, but your daughter's 12th class will happen in 2027 if that is when it has to happen. It cannot happen in 2028, nor can you say, oh, can we just push that goal a little behind? That's not possible. Yes, marriage, vacations, buying a car, buying a bigger house are all goals with a not very fixed date, but the education goals are with fixed date. So it does not make sense to be too much in equity, especially when the goals are nearby and you are not very comfortable with equity fall. So when people say I have a high risk appetite for equity, the question to ask is, what was your equity allocation in 2008? What was your equity allocation in the year 2000? What did you do with your dot-com stocks when the dot-com crashed? What did you do with your mutual funds when the NAV came down to 2? Right? These are the questions to ask. What did they do last time is far more important than what they are saying now. The other thing which they say is, oh, I can take a 30% loss in my portfolio. Don't believe it at all, because people don't understand percentages at all. So when a person has 10,000 rupees in his portfolio, he can take a 3,000 rupee loss. Yes, he understands that. When he has 1 lakh in his portfolio, it means a 30,000 rupee loss. He understands that. But when it's a 10 crore portfolio, a 3 crore loss is too big, because he's not really earned the 10 crores. He has invested, that has grown. So that is how it becomes 10 crores. Now to say you can lose 3 crores is huge. So when a person says he can lose 30%, you have to translate it, sit with his portfolio or with her portfolio and say, look, you got 10 crores in all of your liquid assets put together. You have a house which may or may not appreciate or depreciate, doesn't matter, you're going to live there. Now this 10 crores goes to 7 crores, which means your equity gets wiped out by about 60% or 65%, and this happens and this happens. Can you take a 3 crore loss? And the immediate recoil would be, and the reaction would be like, oh my god, that's not what I meant. So ask them to translate how much of the equity fall you can take, how much of risk you can take in debt funds. I don't understand the taking risk in debt funds, but yes, people do take a risk in debt funds to earn that extra 0.5%, 1%. To me, it makes no sense. I take all my risk in equity, and in debt I don't take any risk. I'm in ultra short bond funds or gilt funds. I have some money in credit risk funds simply because I thought when everybody is panicking, it's a good place to be in. I've got a good return, but that was more like having fun rather than having some money in that, very sensible money in that. So the next thing which people will tell you is, I do direct equity. Some of them may understand, some of them may not understand. So check out their heavy equity allocation and find out how they behaved last time when the market went down, and what did they really do. Second, I have no clue why, but most clients, even in their 30s, 40s, 50s, especially if they are doctors, etc., they prefer current income. So they would want money to be kept in bank fixed deposits, and I don't understand this at all, because I would any day prefer that money, even for debt, be kept in debt mutual funds, because most of us don't touch an emergency fund. I'm not trying to boast, it's maybe God's blessing, but I've never had a need for an emergency fund. That's my luck. But that is what has happened in 40 years of investing. Do I have money in the bank? Do I have money in ultra short bond funds? I have, but I wouldn't bat an eyelid selling my equity also during a bad time, because I've got very, very old equity. When you have very old equity, suppose you have Nestle which costs you 1 rupee and today the price is 20,000 rupees. Does it really matter whether you sell it at 20,000 or during a 5% fall or a 10% fall it is at 18,000? I would be indifferent as to what price I sell my Nestle, Colgate, HUL. It wouldn't really matter, right? So don't bother too much about current income. So don't have to keep money in bank fixed deposit and earn interest on that. Here I'm talking of somebody with 5-10 crores of money, but otherwise if your portfolio is 50 lakhs, 1 crore, then keeping money in bank fixed deposits may not be too bad, because, or even in a savings bank account, because interest on that is tax free up to 10,000 rupees, etc. So it may not matter. But especially for the higher income person who has a high current income, trying to get income out of your investments makes no sense. So putting your money in a property where you get rental yields is still okay, because the rental yields are very low and maybe you're playing for appreciation. Putting money in equities is still okay, because you get maybe 1% return. But keeping money in a bank fixed deposit and paying tax on it unnecessarily with liquidity which you do not need does not make any sense. Keep it in an ultra short bond fund or even in a liquid fund with a growth option, and that's good enough. Don't try to get current income. I've had a lot of problems talking to people saying you don't need current income. The other problem comes to diversification. Some people want to be diversified and be invested in every country, and some people will say, no, I just want 1 or 2 funds. Both may not be right, because last few years I've earned very well, reasonably well in the US markets. I've not earned well at all in European markets. I've earned reasonably decent on an SIP even in the Japanese market, but the Chinese market was very attractive after the Chinese crackdown on their best companies, right? After that, if you have invested, you could do better. But if you had invested prior to that, if you were invested there in the beginning of 2021, you would have lost money. So it makes some sense, especially for people with an investment horizon which is long and with at least $1 million in liquid assets, which means 8-9 crores, 8 crores at least in liquid assets or investable assets. Then it makes some sense to have international diversification. I am also internationally diversified. I have an international REIT. I have an international debt fund, which I hope will just protect me against the rupee depreciation. So it's nice to have this, but they are not significant in my portfolio. I mean, I would be allocating a very small amount, but I still have it. because it's nice to take some money off the table in a booming equity market and put into other assets which are now not doing well, but hopefully it will do better with time. So some diversification is nice and useful, so have that, but don't have to over diversify. The other thing which is worrisome is when people have too much of debt and they're continuing to invest thinking that interest rates will not go up and equity markets will continue to give 42% return or 22% return when your home loan is being in debt or having debt and having equity investment makes sense. However, if your debt is too much, let's say your annual income is 50 lakhs and you have 50 lakhs in debt, then it does not bother me too much. As long as your current outstanding debt is less than your 1 year's income, it does not bother me at all, because you're continuing to pay the EMIs, you're very comfortable, your equity is doing well, you have got some debt instruments, some liquid instruments in case of an emergency. If all that is fine, then a 50 lakh debt and a 50 lakh current income doesn't matter. So which means if you have a 1 crore income and you have 50 lakhs of debt, then it does not bother me at all, because you're getting some tax relief which you're continuing to take, and makes no sense. But yes, you are continuing to take your section 24 benefit or whatever it's called now. So that's okay. But however, if you have got a 50 lakh salary, not a very certain job, I mean, if you're working with a government regulator and earning 50 lakhs, does not bother me at all that you have a 2 crore debt or a 3 crore debt, because you're very unlikely to lose your job, and it's also unlikely that you may have borrowed so much. So both that does not bother me. But if you are working in many of the industries today which are volatile, if you're in an equity dealer, if you're working in telecom, if you're working even in a hospital as a doctor, some of these businesses, some of these incomes are fixed and some are not so violent in terms of fluctuation. But for an equity trader, you could get a salary which is like this, but a bonus which could vary like this. If the markets are volatile, that would also vary. For such people, I would still suggest that taking some money off the table in equity and paying off the debt makes sense. For people with less than 3 years CTC in home loan, does not bother me much, especially if the husband and wife both are earning and the husband's money is being used to repay the loan, the wife's money is getting invested. Then on an overall basis, it doesn't bother me too much. But yes, you should be worried about having too much debt even in this market with so-called low interest rates, because equity markets could go down, which means the so-called profit which is left on the table could get wiped out, and interest rates could go up. A terrible combination for you, because your EMI will go up and your value of your equity stocks will go down. So don't do that. Another set of people are those who say, oh, I don't want to remove from that fund because I will have to pay tax. You will have to pay tax sometime, right? So don't bother too much. Don't worry too much about tax as far as investments are concerned. Having said that, I also mean that when you have a choice of keeping money in a bank fixed deposit versus a liquid fund or an ultra short bond fund, it makes sense to keep in the mutual fund, because suppose it's an emergency fund and you don't touch it for 5 years, which means you will pay tax after 5 years. And if you don't, and if you're like me and if you've never touched it, maybe you will withdraw after 20 years or 25 years. So that way you have to consider tax, but you should not worry too much about taxation, saying, oh, I bought this share, it has gone up so much, but I don't want to sell because there is tax. Look, there is 15% short-term capital gains tax or 10% long-term capital gain tax. I can still understand if short-term capital gain was 20% and long-term capital gain was 0. It doesn't really matter too much, so don't worry too much about taxation. Pay your taxes, reconcile to the fact that if you earn money, you will pay tax. Then there is another set of people with 2-3 crores, 5 crores of net worth and saying, I want to put money in PMS, I want to put money, or I want alternative AIF, or well, I would look at other instruments only after I reach a net worth of about 10 crores. Unless you don't need to, because there is no great public scrutiny of of a PMS or an AIF, so I would not put there, and I would put at least 1 crore in a PMS. I won't put 25 lakhs in a PMS or 50 lakhs in a PMS. I would actually think I would put only 2.5 crores in a PMS. If I want to put money in a PMS, I would put 2.5 crores with one person, because that person makes some sensible money. He or she will sit and talk with me about what is happening. Otherwise, if your PMS is going to get treated like just like a mutual fund, then I doubt whether there's any great benefit. But yes, people have that. I see people even with 2.5 crores wanting to put 50 lakhs and saying, oh, that fund has done very well, because some funds are well marketed, some funds have a lot of sex appeal, so people want to say, oh, I'm in this fund, I'm not naming the fund. So you all know some funds are sexy and over marketed, so those are the funds which keep attracting more and more money. Another set of people say, oh, I don't want to put money in bonds because the interest rates are too low. Exactly, that is the time when I am putting money in a gilt fund, knowing fully well interest rates will go up. But my gilt fund is an SIP, and I know I will pump in money when the interest rates really go up and the portfolio value falls. Why am I doing an SIP? Because I have no clue how interest rates will go, and in this fund I'm sitting with almost a 10% kind of a return over the last 3-4 years, 5 years perhaps. And that is fantastic on an SIP basis. If I'm getting that kind of a return, I know that is not sustainable, but to think that interest rates will definitely go up or definitely go down, and to know the quantity and when it will go up and when it will correct itself, don't pretend. So doing a SIP in a gilt fund to me makes sense. To you, if it does make sense, then do it, but don't say that I will not invest in bonds now because interest rates are too low. What happens if it gets lower? When interest rates were 18% a few years ago, nobody knew that it go down from 18 to 6% or 7%. In fact, in the US from 1980, it must be, when it was 18% to less than 1.8 today, or just about 1.8. How many people also knew that US would stick with a negative interest scenario for such a long period, right? So inflation, they accept 7%, and if the 10-year gilt, the US gilt is less than 2%, which means you're sitting on minus 5% return. That's huge. So don't worry too much about bond yields being low. Also think about what happens when inflation gets higher. Then when bond yields will get higher, and that is the time when you can invest. But doesn't mean your investment in bonds should now be zero. So can I get higher rate of interest and beat inflation by reducing the quality of my debt portfolio? This is another question which is very difficult to handle. Exactly at a time when markets are very expensive and interest rates are very low, people are likely to make mistakes about quality of their portfolio, because it is easy to go down on the quality of portfolio and increase the yield, or go down on the quality of shares that you buy because you think the PE is low. This is a disaster which is waiting to ruin your portfolio. Telling this and conveying this to the client is your job. I know it's difficult, but go up in quality during difficult times rather than go down in quality. If you go down in quality, chances are there will be huge capital loss, and it is just waiting to hurt you. So pay off your mortgage. If you don't have mortgage, don't say I will not have some debt. If you have mortgage, yes, may not make sense for you to invest in debt beyond the requirement of your emergency fund or immediate requirement of 2 years, 3 years, but then it does not make sense. But otherwise it makes sense. For somebody like me who has got a surplus, who does not have any debt, it makes sense to keep money in a gilt fund on an SIP basis. Just find out whether it matters for you. I think I have more or less exhausted. When one more thing is two versions. One person saying I want a lot more liquidity than what you think he needs, and another person saying I don't need so much liquidity, I will never have an emergency. Both are wrong. You have to hit a sweet spot between what is absolutely necessary and what is an ideal condition and what is an excess. Finding the exact amount is not very easy, but not very difficult either. For somebody with a good job in a good company can also be a source of emergency fund. If you have a credit card with a 15 lakh credit limit, that's again a source of the fund. 45 days, it takes 45 days for you to then dilute some asset and repay. So it's possible. So be careful about how much liquidity, because a lot of liquidity actually is a drag on your total portfolio. But not having liquidity can be very embarrassing, because there is a Sindhi saying which says, "Jo kam paisa kar sakta hai, wo sirf paisa kar sakta hai." So true. So sometimes when you need liquidity, you cannot go to your brother, sister, neighbor, friend and say, they'll tell you, okay, I can give you hug and kisses, but I myself don't have cash, right? So find the sweet spot and make sure that the client understands. Thank you.